Good evening, students. Welcome to the session. Yes, so I hope you have revised everything what we have done in the last class. So last class we finished off the assessment of various entities and we had started with the ICDS, if you remember. Now what I'll be doing is I'll be finishing off the balance ICDS which is there, and then we will be progressing on to the assessment procedures and income tax authorities chapter. Is that clear? Okay. So let's get quickly started with the chapter of ICDS. So ICDS, till ICDS 4, if you remember, we have finished it. Now we have to start from the ICDS 5 onwards. For the ICDS 5 also, if you remember, while discussing the depreciation part, I had done ICDS 5 with you, right? So we have done ICDS 5 while discussing the depreciation part, tangible assets. Now only little bit is remaining, so that I'll just take care very quickly. Okay. So ICDS 5. This is for the tangible assets. Now, what does ICDS 5 says? ICDS 5 talks about the recognition of the tangible assets, right? So we have already discussed about it, that how do we recognize the tangible assets, right? When there is the benefit of enduring nature. If you remember, we had done that while we were doing depreciation. So at that point in time, you have to capitalize the expenditure, right? Now, what it exactly says, let's try and understand about the tangible assets. So ICDS 5, which is there, it is talking about the recognition, as I told you, right? The recognition of the tangible assets. What is a tangible asset? It is defined tangible asset as land, building, machinery, plant, or furniture held with the intention of being used for the purpose of producing or providing the goods or services and is not held for sale in the normal course of business. It says that the determining whether an item is to be classified as the tangible fixed asset, in that case, what you need to see is that you need to see whether there is the expenditure which is leading towards the enduring nature benefit. Or for that matter, if it is a case where the fixed asset is coming into place, it is for the purpose of producing or providing goods or services. So in that case, you will recognize the item as the tangible fixed asset. Standby equipments are also to be capitalized. So say for example, where you have the, let's say inverters, okay, or the generators, which are not used for the purpose or which are not put to use, but are kept in spare. Let's say if one of the inverter goes away, then we will use this. It's a spare inverter or generator. Then even standby equipments are to be capitalized. Machinery spares which are there are to be charged to revenue as and when they are consumed. Right? Now, how do you recognize the intangible? That also we had seen that you will consider the purchase cost, the import duties, the taxes, and you will reduce the subsidies or the amount of the cost which is met directly or indirectly by any authority, right? Any trade discounts that are to be reduced. So explanation 1 to section 43, 43.1 provided the, or explanations to section 43.1 provided what is to be included in the fixed asset, what is to be excluded. Similarly, ICDS is also talking about the same thing. Are we clear? For the foreign exchange fluctuations, 43A was talking about it. Here ICDS 6 will talk about it. That also we have already done. Clear? The expenditure incurred on the startup and commissioning of the project, including the test runs, experimental production costs, or the trial run income are to be reduced. Are we clear? So that is same thing what we have seen at that point in time. So it is same manner what we are seeing for 43(1), same principles are given under the ICDS. When a tangible asset is acquired for a non-monetary consideration. So when the tangible fixed asset is acquired for exchange of another asset, then the fair value of the tangible fixed asset will be recorded as the cost. If it is acquired in exchange of shares or securities, then the fair value of the fixed asset will be the actual cost. Any repairs or improvements that increases the future benefit of the existing asset beyond its previous performance which was there will be capitalized. If it's a normal routine repair, that will become the revenue expenditure, right? Then, as I said, this is what the ICDS 5 talks about. That's it. Other than that, we have done that. ICDS 6, we have already covered. Then ICDS 7, which was their government grants, that also we have covered while we were doing the depreciation part. We have covered in totality. Entirely we have covered there. Now we have to cover ICDS 8. ICDS 8. So ICDS 6, which was there, which was the foreign exchange transaction, that we had covered while we were dealing 43A under the depreciation part. That we have entirely covered there. Okay. Then the ICDS 7, which was there, that also we have entirely covered, which was government grants. Clear? Now ICDS 8, which is for the securities. What does ICDS 8 talks about? ICDS 8 deals with the securities held as stock in trade. Securities held as stock in trade. Now, what does it provide? The security shall be recognized at actual cost. ICDS 8, securities held as stock in trade. Right? So it says that it has to be recognized on actual cost. Recognized on the actual cost. And the actual cost will be the purchase price, including the brokerage fees, taxes, duties, cess. Purchase price plus brokerage plus taxes, right? All that will be included. Where the security is acquired in exchange for other securities, then the fair value will be the actual cost. Or if it is acquired for another asset, then it will be the actual cost, which fair value will be recognized as the actual cost. So in exchange of acquired in exchange of other asset, then the fair value. Are we clear? Now, at the end of the year, it will be valued at cost or NRV, whichever is lower. Year-end value at cost or NRV, lower of this. And this will be done category-wise and not for individual security. So category-wise means the categories will be shares, debt, then convertible securities, and others. So it will not be done for individual security, but it will be done category-wise. Are we clear? And if it is securities held by the public financial institutions or scheduled bank, then it will be recognized in accordance with the guidelines issued by the RBI. If it is the securities held by bank, then it will be recognized as per the RBI guidelines. Next is ICDS 9. borrowing cost. This also we have covered it entirely while we were doing the depreciation. So that also we have entirely covered. Are we clear? That also is done. So this is also I'm not doing at the moment because we have already covered it. Then last ICDS is ICDS 10, provision, contingent liability and contingent assets. Now this ICDS provides for the treatment of provision, contingent liabilities and contingent assets. So provision means a liability which can be measured only with a substantial degree of estimation, right? Now contingent liability is a possible obligation that may arise from the past events and the existence of which is confirmed only by occurrence or non-occurrence of a particular event. Because there is no certainty, reasonable certainty that there will be the outflow of resources, or it cannot be reliably estimated, so it is shown as contingent liability. It's a probability, a possible obligation. Contingent asset is a possible asset that may arise from the past event, which will be confirmed only on happening or non-happening of a particular event. So what does it provide is that the provision will be recognized when provision when a person has the present obligation, there is present obligation as a result of past event. It is reasonably certain that an outflow of resources embodying the economic benefits will be required to settle the obligation. It is reasonably certain that an outflow of resources embodying economic benefit will be required to settle the obligation. A reliable estimate can be made of the obligation. Reliable estimate can be made of obligation. So, if these three conditions are satisfied, only then you can recognize the provision. So, there is a present obligation arising out of the past events. It is reasonable certainty that there will be outflow of resources and the reliable estimate can be made. In one of the questions we were solving under MAT, there was an adjustment of provision for a certain liability, provision for gratuity by the actuary based on the actuarial valuation. So I told you that this is provision for a certain liability and therefore it will be recognized. If it is a provision for unascertained liability, cannot be ascertained reliably that there will be outflow of resources, the reliable estimate is not made. In that case, the estimate was made by actuary, so it will be recognized. Until these conditions are fulfilled, it will not be recognized. Are we clear? If let's say, for example, as on today, let's say an amendment has been proposed, raising the taxes, let's say to 20%. Just an example. Now, whether I can make a provision based on that, the answer is no. I can make the provision only when the legislation is enacted and not when the law is just proposed. So, in case where this can come as a part of adjustment in the exam, where details of proposed law are yet to be finalized, obligation arises only when legislation is enacted. Then this is for the provision. Okay. For the contingent liability, this will not be recognized. Contingent liability not to be recognized under income tax. Similarly, contingent assets also not to be recognized. It is only when it becomes reasonably certain that the inflow of the economic benefit will arise, the related income and asset will be recognized. Are we clear? So until then, the contingent liability and contingent assets are not to be recognized. Are we clear? Any doubt? Any question? Any doubt? So this was about the ICDS. Okay. Now we move on to the next topic altogether, which is the assessment procedures. Assessment procedures. Okay. Now this is very, very important topic because of the amendments it has, and therefore it becomes very, very relevant for you to understand this topic very carefully. Clear? So this is very important topic. Students usually, try to skip this particular topic, but I would not suggest doing any of these things because this is these are, easier marks to be fetched also, because if you know the procedure, you can write it very easily. Otherwise, what becomes is that you may not be just going through that or understanding the provision, and you would be losing out on the cash marks, basically. So this is very important to understand the entire chapter. Okay. So let's start with the assessment procedure. But before that, we have understood the computation of income. We have gone through the heads of income. How are we computing? Then we have gone through the clubbing provision, set off carry forward, chapter 6A deduction. I think only for the income computation, only one chapter is remaining for your purpose, which is the charitable trust. Other than that, we have covered every other provision, right? And then, of course, the international tax law, which is pending. So that is something, of course, yes, you will have to do it. But other than that, if you see, when we started off our lectures in December, what did we start with? Basis of charge, section 4. Then we went to section 5 and 6 to determine the scope of income, residential status. I told you at that point in time that there are chapters under the income tax law. Then we did the computation of total income, which was chapter 3, under which we had different heads, right? Then we did the clubbing provisions, set off carry forward, chapter 5 and 6. We did deductions, chapter 6A. We did about AOP, BOI, assessment of various entities, right? Now, all that is the taxability part. Now we are slowly and steadily entering into the machinery provisions. And one of the machinery provision is these return obligations, the income tax return obligation, because now that you have determined your total income, the tax officer will first examine your income determination. And for him to examine, what would you do? How would you show him that this is your income, this is your tax? You would file your return of income. Before that, during the year, you have certain other obligation, which is advance tax obligation. You have to pay your advance tax in 4 quarters, right? The income tax department collects the taxes in advance only. Plus you have TDS obligation. All of that will be again taken care of in separate lectures. But how would you disclose your income to the income tax department? For it to verify, it will be through return of income. See, when you are even sitting for exams, you have studied all throughout the year, right? Now you would be studying till April. Now, how would the examiner know whether you have studied properly or not? Obviously, when you will write the exam, when you will appear for the exam, right? Now, only when you will appear for the examiner will get to know how much you have studied, what you have studied. The assessment procedure also operates in a similar way. So, the very first step in the machinery provision is the return of income. Till now, what we have done is the computational mechanism of the income tax. The first part was the charging mechanism, the charging provision, section 4, 5, 6, 9 order. Then we went to the computation mechanism. For different heads, we had different computation mechanism. Now we are entering into the machinery provisions, right? So now we get into the machinery provision. First point is the return of income. Return of income obligation. Section 139 is providing for the return of income. Who is required to file the return of income? But before we go into the return of income, one very important thing which is required to file the return of income or to create your login or profile with the income tax department, you need the permanent account number. Without that, you cannot create your income tax database or income tax login or profile with the income tax department, and you would not be able to file your return also. So the first thing is that you need to obtain the permanent account number. Now, who is required to obtain the permanent account number is given under section 139A. Is given under section 139A. 139A of the Income Tax Act talks about the PAN requirement. Person who are mandatorily required to apply for the allotment of the PAN. So PAN section 139A. So every person whose total income exceeds the maximum amount which is not chargeable to tax, meaning any person's total income, if it exceeds the basic exemption limit, he has to apply for PAN. So every person whose total income exceeds the basic exemption limit, he has to apply for the PAN on or before the 31st May of the assessment year for which the income is assessable. On or before the 31st May of the assessment year, he has to apply for the PAN. Let me do one thing. Let me, instead of writing here, let me just put it here, your module itself. Give me a second. So every person who is required to obtain the PAN, who has the income more than the basic exemption limit, is required to obtain the PAN. And he has to make the application for the PAN on or before the 31st May of the assessment year. So are you able to see this? If you see 139A, yes. See, every person, if his total income or the income of which he is assessable under that during the previous year exceeds the maximum amount which is chargeable to income tax on or before 31st May of the assessment year for which the income is assessable. Are we clear? Clear? Now, if you see here, every person carrying on any business or profession whose total sales, turnover or gross receipts are likely to exceed rupees 5 lakh in any previous year, then in that case, before the end of the financial year, he has to obtain the PAN. He has to apply for the PAN. Right? They have to mandatorily apply for the allotment of PAN. Every person who is required to furnish the return under 139(4)(a). What is 139(4)(a)? 139(4)(a) is in respect of the charitable trust and institutions if they are required to file the return. So 139(4)(a), if a person is required to file the return of income, which is a charitable trust, then in that case, they have to apply for the charitable trust before the end of the financial year. Every person being a resident other than an individual which enters into a financial transaction of an amount aggregating to 2,50,000 or more in a financial year. If it is a case of other than individual entity which is there, which is required to, which is entering into any financial transaction, then it is required to obtain the PAN on or before the 31st May of the immediately following financial year. And every person who is a managing director, partner, trustee, author, founder of the above person, then in that particular case, above as in the one entity which has entered into a financial transaction, and any partner of that entity or director of that particular company, they are also required to obtain the PAN on or before the 31st May. Are we clear? So this is the requirement of obtaining the PAN. Now, if you see what does it provide is that the assessing officer shall then allot the PAN. These particular person are required to apply for the allotment of the PAN. Before this particular date, they have to make the application and the assessing officer will then allot the PAN. So Rule 114 requires that you submit with the PAN application the proof of identity, the address, date of birth proof, and then they will allot you the PAN after verifying everything. Now, there is an exception to this rule which says that a person who has not been allotted a PAN but possesses the Aadhaar number, then he shall be deemed to have applied for the allotment of PAN. So, Aadhaar can be used in lieu of PAN. Or Aadhaar can be used to even obtain the PAN. Aadhaar can be used to even obtain the PAN. Are we clear? Any doubt till now? Okay. Now, porting of PAN is mandatory for the following transaction. And what are the transactions? Let's see. Sale or purchase of a motor vehicle or vehicle as defined in the Motor Vehicles Act. Opening and saving bank account or current account, right? Then you are required to quote your PAN. Making any application to any bank, you are required to quote the PAN. Opening of demat account, payment to a hotel or restaurant where it exceeds 50,000. So if, say, for example, you are making payment to a hotel where the amount exceeds 50,000, they will ask your PAN. Payment in connection with travel to any foreign country or payment for purchase of any foreign currency, again 50,000 limit if it exceeds. Payment to a mutual fund for purchase of mutual fund units, if it exceeds 50,000, they will need your PAN. Payment to a company or an institution for acquiring debentures or bonds issued by amount exceeding 50,000. Payment to purchase the RBI bonds if it exceeds 50,000. Deposit with the banking company, the term deposits, right? If it exceeds 50,000, or if you're depositing with any bank, then they will ask for the PAN if the cash deposits exceed 50,000. Purchase of the bank drafts or pay orders if the payment exceeds 50,000. FDs with the bank or post office if the amount exceeds 50,000 or 5 lakh rupees during the financial year. Then payment of life insurance premium where the premium exceeds 50,000. Purchase of shares exceeding 1 lakh rupees or any securities exceeding 1 lakh rupees. Sale or purchase of the shares in a company not listed on recognized stock exchange if the amount exceeds 1 lakh. Sale or purchase of any immovable property, amount exceeding 10 lakh. Sale or purchase by any person of goods or services of any nature, amount exceeding rupees 2 lakh. So on 2 lakh invoice value, you need to obtain the PAN, or you need to basically quote the PAN. Are we clear? Now, in certain categories, the PAN requirement has been exempt. What are the category? It is not applicable to a non-resident. PAN is not required to be obtained by a non-resident. In respect of the transaction, other than the transactions which are at serial number 12478. What are at 12748? If non-resident purchase motor vehicle or sale motor vehicle, he is required to obtain PAN. If he is opening a bank account, he is required to obtain PAN. If he has a demat account, he has to obtain PAN. If he is purchasing mutual fund units over 50,000, he has to obtain. If he is purchasing the bonds of the company exceeding 50,000, he has to obtain. Right? And in case he is depositing with a banking company cash deposit of exceeding 50,000 in a day, he has to obtain PAN. He is taking some FD over 50,000, he has to obtain PAN. Or he is purchasing the life insurance policy of more than 50,000, he has to. Or if he is purchasing any sale, he is making sale or purchase of any goods or services exceeding rupees 2 lakh per transaction, he has to obtain the PAN. Sorry, not in that case. Sorry, the immovable property one. Immovable property or sale purchase of any shares of unlisted company or any securities, then in that case he has to obtain. Other than these transactions, non-resident is not required to obtain the PAN. Are we clear? Any questions so far? Any doubt? Yes, any questions, any doubt? So in all these cases, quoting of PAN is very much mandatory. Any person who does not have PAN and who enters into any transactions which are given in the table will make a declaration in Form 60 giving the particulars of the transaction. Are we clear? So if any person does not have PAN and who enters into the transaction will make a declaration in Form 60 giving the particulars of the transaction. Are we clear? Now, every person who receives any document relating to any of these transactions shall ensure that the PAN is duly quoted in the document. Every person who receives any amount from which TDS has to be deducted will have also to intimate his PAN to the person responsible for deducting the TDS, else the TDS will be deducted at the higher rate. Because PAN is required to be quoted in the statement furnished for the perquisites or profits in lieu of salary, in the TDS TCS certificates, in the TDS TCS returns. If the PAN is not furnished to the person who is required to deduct TDS, then the TDS will be deducted at the higher rate. Are we clear? Any question, any doubt? In case the person does not have PAN, he can quote, of course, the Aadhaar also. Then he can quote the Aadhaar also. Now, as I said, the 139A will not apply to the non-resident other than the transactions which are given as the exception to that. Are we clear? Now, one more thing, it does not apply to certain categories of the investors as well. And what are these categories of the investors? Let's look at it. See. 114 AAB rule provides that provisions of 139A shall not apply to a non-corporate, non-resident or a foreign company who has made investment in the specified fund. Specified fund is AIF. To a non-resident being an eligible foreign investor who has made the transaction only in a capital asset, which is the bonds or GDRs or rupee-denominated bonds of an Indian company, which are listed on the recognized stock exchange located in any IFSC. And the consideration on transfer of such capital asset is paid or payable in foreign currency if the following conditions are satisfied. Non-resident does not earn any income in India other than the income from investment in the specified fund. Similarly, the eligible investor does not earn any income in India other than the income from transfer of capital asset. Any income tax due on the income of the non-resident has been deducted at source and remitted to the government at the rate specified in 194 LBB. The non-resident or eligible foreign investor furnishes the details and documents such as name, email ID, contact number, address in the country of which he is resident, tax residency certificate, and tax identification number. Are we clear? So, in this case, if it's a non-resident or eligible investor, foreign investor, who is having the income from IFSC through the bonds, or the non-resident or foreign company which has the investment in AIF, they are not required to obtain the PAN. Clear? Okay. Now there is one more amendment over here. And what is the amendment? Let's try and understand. Now there is amendment under 139A, as I said. What does the amendment provide? The amendment is in respect of the rules for the PAN. And what are the rules? So there has been a new rule, 114BA has been inserted, 114BA, which prescribes the transactions. The CBDT is prescribing certain transactions where the PAN application needs to be made by the person in case he intends to deposit the cash in the account which is going to exceed rupees 20 lakh or more. If a person is intending to deposit 20 lakh or more in the account, the cash deposit, then he has to apply for the PAN 7 days before the date on which he intends to deposit the cash. Or if he is intending to withdraw the cash from his accounts during a financial year which is exceeding rupees 20 lakh or more, he has to at least apply 7 days before the date on which he intends to withdraw the cash. Or any person who is intending to open a current account, cash credit account, has to apply at least 7 days before the date on which he intends to open the account. These are the 3 cases where you have to apply before doing the transaction. Similarly, there is another rule which has been inserted, which is Rule 114BB. We have seen 114BBA. We have 114BB to prescribe that every person has to, at the time of entering into a transaction, quote the PAN, and every person who receives the document in which the PAN is quoted has to ensure that the PAN is correctly quoted. And which are the transactions for that? Cash deposit of 20 lakh or more in the bank account, cash withdrawal of 20 lakh or more in the bank account, or opening of the current account. Are we clear? So this is the amendment which has been there for the PAN. So maybe you can just write it over here. Here. Rule 114BBA. Cash deposit greater than rupees 20 lakh. Cash withdrawal greater than rupees 20 lakh. Opening of current account. In these 3 cases, you have to apply at least 7 days prior. And similarly, you have to quote it when these particular transactions take place. This is in Rule 114B. Duly quote back. Clear? Okay. Next is the Aadhaar number. Okay, what are the before that, what are the penalties for failure to comply with the provisions of the PAN? Failure to comply with the provisions of 139A, there is penalty of 10,000. Failure to quote the PAN or Aadhaar in any document, 10,000 for each default. Failure to intimate the PAN or Aadhaar as required in the section 139A, 5A or 5C. Now, what is 139A, 5A or 5C? 139A, 5A section, subsection 5A provides that every person is required to intimate the PAN for the TDS, and 5C is the TCS. So this is for TDS or TCS. Then again, it is 10,000 for each default. Or quoting the false PAN is also rupees 10,000 for each default. Similarly, failure to quote PAN or Aadhaar in documents referred to in 139A, 6A. 6A is basically for documents pertaining to the transactions, which are prescribed in the table, right? Then again, 10,000 for each default. Or failure to ensure that the PAN is duly quoted, again 10,000. Clear? So 10,000 is basically the penalty which is there for wrong quoting or failure to comply with these transactions. Then we move towards 139AA, which is quoting of Aadhaar number. Now, every person who is eligible to obtain Aadhaar is required to mandatorily quote Aadhaar in the application form for the PAN. So your PAN will be linked to the Aadhaar. And where the person does not have Aadhaar and he has applied for the Aadhaar, he can also quote the enrollment ID. Now you have to also link the PAN with the Aadhaar. In case you already obtained PAN and then you have obtained the Aadhaar, you have to link mandatorily the PAN and the Aadhaar while filing the return of income. If you have not linked the PAN with the Aadhaar, then in that case, it will be deemed that your PAN has become or you have not obtained the PAN. So consequences of failure to intimate the Aadhaar, if a person fails to intimate the Aadhaar, then such person, the PAN of that person will become inoperative after that date. The PAN will become inoperative. Okay. Making the PAN inoperative. So your PAN will become inoperative, and if the PAN becomes inoperative, then it shall be deemed that he has not furnished, intimated or quoted the PAN as the case may be. And if that be the case, what will happen? If it is deemed that you have not quoted or intimated your PAN, then in that particular case, the person would not be able to file the return. Then in that particular case, not able to file the return. Secondly, pending returns will not be processed. Pending returns will not be processed. Refunds cannot be issued. Proceedings cannot be completed once the PAN is inoperative. And tax will be deducted at the higher rate. ICDS at the higher rate under section 206AA. Okay. So this will be effective from 1st April 2023 with effect from 1st April 2023. This will be effective from 1st April 2023 and not from 1st April 2022. These consequences will be applicable from 1st April 2023. Clear? Plus there is fee which is going to be charged. And what is that fee? So rule 1145A provides that if a person fails to intimate the Aadhaar before 31st March 22, then at the time of subsequent intimation of his Aadhaar number to the prescribed authority, such person would be liable to pay a fee, and the fee would be under section 234H. If a person is required to intimate the Aadhaar and he has failed to do that before 31st March 22, he shall be liable for fee under section 234H. And what is the fee which is going to be there? When he would subsequently intimate Aadhaar. This is failure to intimate Aadhaar by 31st March 22. If he intimates within 3 months, that is up to 30 June 2022, the fee will be rupees 500. Else, after 3 months, the fee would be rupees 1000. So again, this is the amendment which is there for your particular attempt. Clear? Now, Aadhaar is not applicable to the following classes, which is residing in Assam, Jammu Kashmir, Meghalaya, a non-resident, age of 80 years or more at any time during the previous year, not a citizen of India. In these cases, the Aadhaar will not be applicable. Are we clear? Any doubt? Hemant, M2M loss, we had done it while we were doing the ICDS for the non-monetary items. So M2M is that you decide on the year end what is the exchange rate and you take the exchange rate difference to the P&L. M2M means mark to market. What is the market rate? You mark according to that and book it, the expense or revenue every year on year depending on the rate which is there. Clear? Okay. Any further questions? Any doubt? Okay. So this is the PAN and the Aadhaar. Now let's get back to the return filing. Okay. Now, who is required to file the return of income? Are you able to see the screen? 1 second. I think this is not expanding. Okay, let's leave this thing. Okay. So who is required to file the return of income? The return of income is required to be filed by any person whose income exceeds the maximum amount chargeable to tax, which is the basic exemption limit. If my income exceeds the basic exemption limit, then I am required to file the return of income. Now, for the purpose of considering the basic exemption limit, I have to consider the income which is before claiming the exemptions. Even the exemption under section 54 series. So I do not have to take the total income which is after those exemptions. I have to take the income which is before claiming the exemptions. Because otherwise what may happen is I may have claimed certain exemption and I will say that okay, I have certain exemptions and therefore I'm not required to file the return. But how does the income tax authority verify whether I have claimed the exemptions correctly or not? And for that situation, they provide that where your income before claiming the exemptions exceeds the maximum amount not chargeable to tax, then you are required to file the income tax return. So if you see over here, every person being an individual or HUF or AOP or BOI or artificial juridical person whose total income without giving effect to the exemptions under 54 series or deductions under chapter 6A exceeds the basic exemption limit is required to file the return of income. So if my income exceeds 2,50,000 or 3 lakh rupees, I am required to file the return of income. Are we clear? In case of company or a firm, they are mandatorily required to file the return of income. Now, in case of individual, again, even if my income does not exceed the basic exemption limit, still if I fulfill certain conditions, I'll be required to file the return of income. And what are those conditions? It is given over here. Give me a second. Okay, it's maybe not there in your module. Yes, this one. A person who is not required to furnish a return, or maybe you can make a chart here to understand it easily instead of referring from module. Requirement to file ITR. Individual total income before exemptions under section 54 or chapter 6A deduction exceeds the basic exemption limit. Deposits greater than rupees 1 crore in the current account. Foreign expense, foreign travel expense greater than rupees 2 lakh. Incurred the foreign travel expense greater than rupees 2 lakh. Electricity consumption or electricity bill greater than rupees 1 lakh. In this case, even if the income is less than the basic exemption limit, you are required to file the return of income. Or if it is a case of ROR, resident and ordinary resident, this particular point. ROR who holds the beneficial ownership or any asset, including any financial interest in any entity located outside India, or has a signing authority in an account located outside India, or is a beneficiary of any asset located outside India. So, ROR who is beneficial owner of any asset or has signing authority or any financial interest in any entity outside India. Or is a beneficiary of any asset located outside India. Beneficiary of asset located outside India. In all of these cases, even if my income is less than the basic exemption limit, I am required to file the return of income. Are we clear? This is for the individual. Now again, there has been amendment. And what is the amendment here? The amendment is in respect of few more category of person who are required to file the return. And what are those? Total sales, or let me write it this at the end. Total sales or turnover or gross receipts exceed rupees 60 lakhs in business. Total gross receipts in profession exceeds rupees 10 lakh. The TDS and TCS aggregate of TDS and TCS is 25,000 or more, is greater than equal to 25,000. For senior citizen, for a resident senior citizen, it is who is greater than equal to 60 years, it is rupees 50,000 or more. So these three are added over here, apart from the earlier ones which are added. So these three are new categories. So even if the income is less than the basic exemption limit, you will be required to file the return of income. Are we clear? So in these cases, you are required to file the return of income. Fine. So this is what is written over here as well in your module. In case of firm, in case of company, it is mandatory. It is mandatory to file the return of income. Clear? Now, what are the due dates? So the due date for the individual is July 31st. For the individual, it is 31st July. For the company also, it is due date is 31st October. For the firm, if the accounts are required to be audited, or even for individual, if the accounts are to be audited, then 31st October. If the audit is required, then it is 31st October. Or if it's a partner of a firm whose audit is required, then also it is 31st October. And in case of assessees to whom transfer pricing is applicable, then it is 30th November, including the partner of such firm to whom transfer pricing is applicable. Clear? Any questions, any doubt? Now, if there is a default is there in furnishing the return of income, then interest under 234A is applicable. And what is the interest under 234A? Where the return is furnished after the due date, 1% from the date of furnishing the return, ending on the date of furnishing the return. And where no return is furnished, then 1% is payable from the date immediately after the due date till the date of completion of the assessment. Are we clear? So then 1% per annum, per month interest is be levied under 234A. Plus there is a fee under section 234F. There is also a fee which is levied under section 234F. And what is the fee under 234F? Under 234F, there is a fee of, you can write down, so there is a fee which is there under section 234F, which is 5,000 rupees. So if a person fails to file the return of income, there is a 5,000 rupees fee which is there. And if the income is less than rupees 5 lakh, if the income is less than rupees 5 lakh, then the fee is rupees 1,000. So this is for income greater than rupees 5 lakh. Income greater than rupees 5 lakh. Clear? So then there is also a fee which is there under section 234F. Clear? Also, there will be penalty which is there in case you fail to furnish the return of income. So where the return of income is not furnished, then in that case, the AO can levy the penalty under section 271F. Under section 271F. Then the AO will levy a penalty which can be levied by the AO. Are we clear? Any doubt? Any questions? Any doubt? Any questions? Yes. Are we clear with this one? Yes or no? Are we clear? So in case you fail to furnish the return of income, then in that case, what are the consequences? In that case, the consequences are that you will be liable for interest under 234A. You will be liable for interest, fees under section 234F. Also, there may be penalty not under section 271F. You can write down concealment of income. Sorry. There could be consideration of concealment of income. That you have concealed the income. So that could be there under 270A. Are we clear? So these are the consequences if you do not furnish your return of income. Fine. Any doubt? The total income. Total income means the total income after all the deductions and everything else. Is this clear? For 234F, it is the total income which is exceeding 5 lakh rupees. Total income means after considering all the deductions and everything else. Delete. Yes? Okay. Now, there are Other kinds of returns also, this is the original return, but there are also exemptions from the return filing requirement for certain person. And what are these exemptions? So in case of non-corporate, non-resident and foreign company having any income which is chargeable from any investment fund set up in IFSC located in India, for which there was exemption under PAN also, and for which TDS has been deducted under 194 LBB. And if they have not received any notice under 142, 148, 153A, then they are not required to furnish any return of income. Are we clear? Or if they have the income from the bonds or the global depository receipts or rupee denominated bonds from the IFSC, they are not required to furnish the return of income if they have only that income and the TDS has been deducted. Plus, with regard to certain non-residents, there are exemptions, particularly in those sections itself where the tax rates are provided. For example, under 115A, 115BBA, where there is specific tax rate provided and the TDS has been deducted in accordance with those provisions, then there is no requirement to file the return of income. Are we clear? Now, next, let's move to the return of loss. Return of loss, which is there. So, Section 80 provides that unless you have furnished the return of income, you will not be allowed to carry forward and set off the losses. What are the losses which cannot be carried forward and set off? If you have not filed the return of income within the time limit of 139(1), your PGBP loss, your speculation business loss, specified business loss, loss under the head capital gains, loss from the activity of owning and maintaining race horses, all of these losses cannot be carried forward and set off if you do not file your return of income on time. Are we clear? Only if it is a case of income from house property loss or the unabsorbed depreciation, that can be carried forward and set off even if the return is not filed in time. Then, if you have not furnished the return on time, you can furnish the belated return before the expiry of 3 months prior to the end of the relevant assessment year. So, which is before 3 months, which is by 31st December. You can furnish the belated return before the 31st December, but in that particular case, you would still not be allowed the deductions which are available under Chapter 6A in respect of certain income, 80IA, 10AA, 80IB. All of these deductions you will not able to claim. You will not be able to claim the set off and carry forward of losses. Plus, there will be interest under 234A. There will be penalty fees under 234F. So, all of these consequences would be still there. Are we clear? But this will be a belated return. Then, there is the return of, there is this revised return, which is provided under 139(5). In case you have committed some error or there is some omission, then by 31st December, that is 3 months prior to the end of the assessment year, you can furnish the revised return. So again, this is by 31st December. You can furnish the revised return. And whether the loss return can be revised? Yes, the loss return can also be revised. Then there are certain returns for the particular taxpayer which are there, which is for the charitable trust under 139(4)(a). So if their income exceeds basic exemption limit before considering the reduction under section 11 or 12, then they are required to furnish the return of income. And their due date is going to be 31st October because these charitable trusts are required to get their accounts audited when their income before the exemption under section 11 or 12 exceeds the basic exemption limit. So they are required to file the return of income by 31st October in that particular case. Return of the political parties is under 139(4)(b). Return of the research association news agencies is under 139(4)(c). Return of universities and colleges is under 139(4)(d), and return of the REIT is under 139(4)(e), and of the InvIT under 4F. So these are the specific returns which are to be filed by these institutions and which are mandatorily to be filed. Are we clear? Any doubt? Any doubt in the return of income? Okay. Now, if the assessing officer finds that the particulars in the return of income are not furnished correctly, or the taxes have not been computed correctly, or the audit report is not submitted along with the return, or the taxes are not paid, or the proof is not submitted for the TDS, TCS, advance tax, right? Or if there is any defect in the return of income, basically, or the books of accounts are not maintained, then in that case, the assessing officer can treat the return as defective return under 139(9). He will issue you the notice that the return is treated as defective return, and he will give you the time to rectify the defect within 15 days. If you do not rectify, it will be treated as that if you have not filed the return of income. Are we clear? So in that case, it will be treated that you have not filed the return of income if you do not rectify the defect. Any doubt? Any question? Okay. So this is about the first step in the assessment procedure, which is the return of income, PAN, Aadhaar, all these requirements. Now we will be then moving towards the second part, that is after you have appeared for the examination. Then it is the case of the assessing officer to verify your details or verify your, in case the examiner, he will verify your answer sheets and will see whether you have studied during the year correctly or not. Similarly, the assessing officer will have the power to verify the details, and if he is not satisfied, the scrutiny assessments will start. But before we move on to the scrutiny assessment, there is one big update or amendment for your attempt, which is in the case of one second. Give me a second. Okay. Updated return. Now, this is different from your revised return. This is not your revised return. Your revised return is when you make certain corrections in your return of income. This is not at all your revised return of income. This is the updated return to be filed. Now, what is updated return? This is provided under section 139(8)(a). So, revised return is when there is error or omission in the original ROI. Then you rectify or revise the return, and the due date is 31st December of the AY. This is your updated return. Now, what is updated return? Now, the updated return which is there, if a person has failed to furnish the return, if a person has failed to furnish the return, or in case he has not declared the income in the earlier return. So 139(4) which is there, which is the revised return, is in a case where you have submitted some incorrect details. Right? You have submitted some incorrect details and now you want to revise it. Sorry, 139(5), not 139(4), the 139(5). So if you discover any omission or a wrong statement, you may furnish the revised return under 139(5). But in the updated return, if a person has not furnished the return altogether, or if he has furnished, he has failed to disclose the material income or material details, then he can file the updated return. So this is basically a scheme which is given to the individuals in order to save themselves from the penalties by suo moto voluntarily disclosing their income. So in case whether or not ROI is furnished, original or revised or belated, any return, if you have furnished revised return, belated return, original return, or if you have not furnished, you may furnish an updated return of income, and you can file this particular return. The due date is 24 months. The due date is 24 months from the end of relevant assessment year. 24 months from the end of the relevant assessment year. So, an updated return for AY 23-24 can be filed till 31st March 26. Are we clear? So you can furnish at any time within 24 months from the end of the relevant assessment year. Now, updated return cannot be filed if it is a loss return, unless loss is being converted to income. Unless the loss is being converted to income, has effect of reducing the total income, has the effect of reducing the total income or total tax, reducing the tax, or results in increase in refund or converting tax to refund, or converting the tax to refund. So in this case, you are not required to furnish the updated return. You are not required to furnish the updated return. So if it is the loss return, you cannot file the updated return unless the loss return changes to the income return. So if the original return is a loss return and the updated return results in the income disclosure, so that the loss is now turning to the income, then you are allowed to furnish the updated return. So let's say, for example, you had declared loss, but now you are offering the income. So then you can file the updated return. In case if it is a carry forward of a loss, now which is turning to the income, or if it is a unabsorbed depreciation or MAT credit, whatever is there. Now, if it is getting reduced, now the effect will be in the all the years where you have carried forward even the MAT or the unabsorbed losses. or the unabsorbed depreciation, right? Say for example, for 22-23 or 23-24, I have the loss. Now I'm filing the updated return. Now this 23-24 loss, I would have carried forward in 24-25, 25-26 also. So I will have to file the updated return for all these 3 years where I'm carry forwarding the loss, because if I'm converting this loss into income, I'm not eligible to carry it forward. And if I have carried forward in the next year, I will have to modify it. So updated return need to be filed for all of these years. Also, when the updated return cannot be filed, it also includes the cases where search has been initiated. Search has been initiated under section 132, or survey has been conducted under section 133A, or a notice has been issued that the money or the assets under section 132 are now being seized. A notice is issued under 132 to seize the money or the assets. So, seizing of money, assets under section 132. Where the reassessment or assessment proceedings are pending or have been already completed. Assessment or reassessment is pending or completed. Where the assessing officer has the information in respect of the person under the Smugglers and Foreign Exchange Manipulators Act, or the Prohibition of Benami Property Transaction Act, or black money law. So in that case also it cannot be furnished. So AO has information under Prohibition of Benami Properties Transaction Act, black money law, where the information is received from the foreign country. AO has received information from foreign country. Prosecution proceedings have been initiated. Prosecution has been initiated. In these cases, the updated return cannot be filed. Are you clear? Now, when you are filing the updated return, then what is the tax on the updated return? So in the case where no return is furnished earlier, if you have not filed any return earlier, then the tax is to be paid along with the interest and the fees before furnishing of updated return. So you have to pay the tax, the interest under 234A, B, C, and the fees under section 234F, which is there for the delay in furnishing the return. That has to be furnished before the furnishing of the income tax return. So, payment of tax, interest under section 234A, B, C, fees under section 234F. All of these needs to be paid. But you will get the credit of course, the advance tax, TDS, TCS, any rebate, any foreign tax credit, any MAT credit, all of that will be given. But the interest under 234A will also be levied, right? And there will be interest also under section 234B. So you will be liable to pay tax along with the interest under section 234A, B, C. Right? Any interest which is paid earlier will be, of course, reduced. Any credit of advance tax, TDS, will also be given. You will also be required to pay 234B on the amount by which the advance tax falls short of the assessed tax. Clear? So 234B will be there, 234C will be there for the shortfall of the advance tax. Now, if you furnish the updated return before the 12 months from the end of the relevant assessment year, you don't need to pay any additional tax. But if you furnish the updated return after the time limit of the belated return or the revised return and before completion of the 12 months. So let's say there will be additional tax also. So if you furnish before the time limit of 139.4 or 5, that is 31st December, then no additional tax. In case you furnish after the time limit of 139.4 or 139.5, but before 12 months from the relevant assessment year, that is 31st March. Now for 2023-24 assessment year, it will be 31st March, let's say 25. For the assessment year 23-24. Then it will be 25% of the tax plus interest. And if it is furnished after the 12 months from relevant assessment year, but before the 24 months, that is, let's say 31st March 26, then it will be 50% of tax plus interest. Tax plus interest. So this is how you will calculate the additional tax, but this will save you from the penalties which will be there for non-filing of the return or for the concealment of income. It will not be at least considered that you have concealed the income. Are we clear? So let's take a break of 10 minutes and then we get back and solve one small example on this and then we move on further. Okay, let's take a small break of 10 minutes. Okay, students. So next, move on to the next part. Sorry, we have to solve the sum. Okay, let's write the question. Mr. X would like to furnish the updated return for AY 21-22. In case he furnished his updated return, he would be liable to pay rupees 2,50,000 towards tax and rupees 35,000 towards interest after adjusting tax and interest paid at time of filing earlier return. You are required to examine whether Mr. X can furnish updated return as on 31st March 23, as on 28th Feb 24, as on 31st May 24. Compute the additional tax. Yes. So please start solving. Yes. What is the answer? Yes, fast. Whether he can file by these dates, yes or no? So yes, he can file by 31st March 23 because it falls within the time period. He can also file by 28th February 24, but he cannot file by 31st May 24. What if, let's say, for example, a notice, reassessment notice was issued under 147 on, let's say, 23rd July 2023. Then in that case, he would have not been able to file the updated return also for AY 21-22 since its proceedings were pending. Right? In for any of the date, he could not have filed for it. Okay. Now, what would be the additional tax? In case he files before 31st December, then there is no additional tax. In case he files in 31st March, then it is 25% of the tax plus interest. So 25% of 2,50,000 plus 35,000. If it is by 28th February, then in that case, it will be 50% of 2,50,000 plus 35,000. Are we clear? So this is how you have to take into consideration the updated return. Clear? Okay. Now let's move forward towards the assessment procedure part. Now that you have filed your return of income, the first process is the summary assessment. Okay, before that, we can do this section 140. Section 140, which is there, is person authorized to verify the return. So who is required to verify my return? So in case it is the individual, then it is the individual himself or the person duly authorized, his guardian or person competent to act on his behalf. In case of Hindu undivided family, it is Karta or any other adult member. In case of company, it is the MD who is required to verify the return or the director of the company. Where the company is not a resident in India, then a person who holds the valid power of attorney. Where the company is being wound up, then the liquidator. Where it's a government company, then the principal officer. And if it's an insolvent, then the insolvency professional assigned. If it's a firm, then the managing partner or any other partner of the firm. And if it's an LLP, then designated partner or any other partner. If it's a local authority, then the principal officer. And if it is a political party, then the chief executive officer, any other association, any member can verify the return. Okay. Now, as I said, once you file the return of income, you have the first summary assessment under 143(1). Now, what is summary assessment? Your processing of the return, right? Where the CPC will process your return. Centralized Processing Center will process your return. So where a return has been made under 139 or in the response to a notice under 142(1), such return shall be processed under 143(1). 143(1)(a) provides for computation of the total income after making the following adjustment. So these are certain adjustments which can be made in the summary return, summary assessment. What is that? They will verify the arithmetical error. They would verify if you have claimed any incorrect deductions or if you have claimed any losses which were not allowed to be claimed by you, or for that matter, if you have claimed the losses even after the time period is over, or if there is disallowance of expenditure or increase in income which is shown in the audit report but you have not considered in your return of income, or you have claimed any deductions if the return is filed beyond the time limit, you have claimed any deduction which is not in accordance with that particular section in terms of, let's say the limit is 150, you have claimed more than that. So these basic adjustments, they will verify. So what they would do is they would just try to do the basic processing of the return. If the item is there is any inconsistency, let's say the profit which is there in the P&L account is different from what you have shown in the business income. And if there is, let's say, for example, the information you have not put in. So all of these basic information they would do. And based on that, they would compute the tax, interest, and fee. And if there is any amount of refund due, that shall also be determined after considering all the MAT credit, foreign tax credit, all of them. And based on that, they will prepare an intimation and send to the assessee. Now, the time limit for processing of the return is 9 months from the end of the financial year in which the return is made. So, 9 months from the end of the financial year in which return is made. So, let's say, for example, if my return is filed by 31st July, then in that case, my financial year would be, let's say for 22-23 financial year, previous year, my return will be filed in 23-24. So 9 months from 23-24, which is December 25, will be the end of the financial year. I can I can process my return, or the CPC can process the return. Okay. In case there is no refund due, then the acknowledgement of, or in case it's a loss return, or in case there is no refund is due or no tax is due, then the acknowledgement of the return shall be deemed to be the intimation. When there no tax is due or no refund is payable, then the acknowledgement of the return is just the intimation. Clear? Now, the return is required mandatorily to be processed even if the notice is issued under 143(2). So, in order to not grant the refunds where the recovery of the revenue is doubtful, it is possible that the assessing officer may think that if the refund is issued to the assessee, then the tax collection will become difficult. So he will record the reasons in writing, and with the previous approval of the principal commissioner, withhold the refund up to the date when the assessment is made. So because 143(1) processing is mandatory before the assessment is completed under 143(3). Right? So 143(1) requires the processing of the return file, and that is to be done mandatorily even where a notice is issued under 143(2). Now, if as per the intimation the refund is due, and if I grant the refund, what will happen? The recovery may become difficult. So in order to withhold the refunds, the assessing officer, with the reasons recorded in writing and with the approval of the principal commissioner, may withhold the refund up to the date on which the assessment is made. Now, this is, as I said, is done by the Centralized Processing Center, CPC. Now, before we get into the scrutiny assessment, we'll first try to understand about the income tax authorities. So, income tax authorities. Now, let's try and understand by this thing. By which are the income tax authority, or how do they function exactly? All that we are required to now look into it. So the income tax authorities, it starts with the CBDT. Central Board of Direct Tax is the top authority. Then we have the Principal Director General and Principal Chief Commissioners of Income Tax. So under the aegis of CBDT, the entire department functions. So we have CBDT, then Principal Director General of Income Tax, or Principal Chief Commissioner of Income Tax. Then we have Director General of Income Tax, or Chief Commissioners of Income Tax, CCIT. And then we have Principal Director of Income Tax, or Principal Commissioner of Income Tax. Or then we have additional directors of income tax or additional commissioners of income tax. And then we have joint directors of income tax or joint commissioners of income tax. And finally, we have deputy directors of income tax or deputy commissioners of income tax. Then assistant director of income tax or assistant commissioner of income tax. And we have income tax officers, tax recovery officers, and inspectors, which is the ITL. So we have the inspectors, tax recovery officers, then we have the income tax officers, then we have assistant director or assistant commissioner, then deputy director, then joint director, then additional directors, then principal director, then director general, principal director general, and then the CBDT. So this is how the hierarchy is. Now, what do we mean by the assessing officer? Assessing officer means the assistant commissioner or deputy commissioner, this thing. Assistant commissioner, deputy commissioner of income tax, assistant director or deputy director of income tax, and the income tax officer. So these are the income assessing officer. They would be assessing the returns. Assistant commissioner, deputy commissioner, assistant director, deputy director, or the income tax officer. So these are usually the income tax officer. In case the additional commissioner or the additional director or joint commissioner or joint directors, if they are also interested with this particular responsibility or they are directed to exercise or perform the powers, then they can also act as assessing officer. But other than that, these are mostly the assessing officer. Are we clear? CBDT, as I said, is a statutory body. It consists of the central government members and it is functioning under the Ministry of Finance. It is the highest executive authority. It exercises the control and supervision over all the officers of the income tax department. And it has the powers subject to the approval or the control of the central government to make any rules for the administration of the Income Tax Act. Are we clear? Now, who appoints this income tax authority? The central government appoints the income tax authority, or it may authorize the CBDT or the principal director general or the higher authorities to appoint the assessing officers. Now, CBDT has a power to issue the directions, to issue the instructions, to the orders to the income tax officers for the proper administration of the act. And the income tax officers are bound to follow the CBDT orders. It is binding on the revenue. However, the CBDT directions are not binding on the assessee. So, CBDT is directions are binding on the revenue but not on the assessee. But CBDT has no power to issue the orders, instructions or directions which required any income tax officer to make the assessment in a particular manner or which interferes with the discretion of the Commissioner of Income Tax Appeals. The authority of CBDT is to issue any instructions for the proper administration of the act, but not to require to make any assessment in a particular manner. Also, CBDT has power to give the relaxations in terms of filing of return of income, assessments, or for that matter, interest, advance taxes, penalties. They can have the power to give the relief in case the assessees are having any trouble, or in case the situation arises. Let's say there was COVID period, there was a situation which required the relaxation in the income tax return filing, in the payment of interest. So it has the power to grant that particular relaxation with respect to the filing of return of income, with respect to the assessments, with respect to the reassessments, with respect to any interest on TDS, on advanced taxes, on interest on advanced taxes, penalties. So CBDT can do that. Are we clear? In case there is a genuine case where the assessee has not been able to file the return, let's say he has not been able to file the return of loss, then in that case, the assessee can, in the genuine circumstances, approach the CBDT under section 119 to grant him the special relaxation. Clear? So this is the first thing about the income tax authority. Now, if you see the income tax authorities which are there, they have the jurisdiction over the particular assessee. The income tax authorities have the jurisdiction over the particular assessee based on where that assessee's registered office is or where he is resident. Based on that, the income tax authorities derive the jurisdiction. In case the income tax authority does not have the jurisdiction, so where the assessing officer has been vested, then he shall have the jurisdiction in respect of the person who is carrying on the business or profession in his area or who is residing in his area. Where there is a doubt, then the higher authorities can resolve the jurisdictional issue. And then the case can be transferred from one income tax authority to the other income tax authority who is having the jurisdiction over the assessment. So the case can very well be transferred from one jurisdictional officer to another jurisdictional officer. Are we clear? So the jurisdiction is dependent on where the person is carrying on the business or where he is exactly the resident. Are we clear? Any doubt till now? Any question, any doubt? Okay. So as I said, that with respect to the jurisdiction of the income tax officer, the income tax authorities which are there, they shall exercise the power in accordance with the directions issued by the CBDT. So they exercise all the power dependent on how the CBDT's direction are. Now, CBDTs may authorize even the Principal Director General or Director General or Principal Director or Director to perform the functions of any other income tax authority as may be assigned to them. So CBDT can issue them the direction as to how they are going to function. Are we clear? Now, if let's say for example, the power to transfer a case from one assessing officer to another subordinate officer is vested with the Principal Director General or the Principal Chief Commissioners. And they can then decide upon as to where the jurisdiction of the assessee lies. And if there is change of the income tax authority, then where the income tax authority succeeds another income tax authority, then the succeeding authority will start the case from the stage where it was left by the earlier authority. And now there is the faceless jurisdiction of income tax authority. So central government has notified the scheme for the faceless jurisdiction, wherein the jurisdiction will be decided in a faceless manner through the automated allocation. So the faceless automated allocation system, the jurisdiction will be decided. Are we clear? Now, What are the powers of the income tax authority? So let's try and understand what are the powers of the income tax authority. So income tax authorities have the power which is vested in a civil court. So powers of the civil court they have powers of the civil court, as in what the civil court has the powers, they also have the powers in respect of the assessments they carry out. They have the power regarding discovery, production of evidence, under section 131, search and seizure, under section 132, then requisition books of accounts, under 132A, power to call for information, under section 132, 133, survey, to conduct survey, under 133A, then power to collect information, under 133B, and inspect register of the companies. Under section 134. But before we understand these powers, we'll first now go to the assessment procedure again, and then we'll come back to this. But this just I gave you the summary, right? Now, understand one thing. We have seen the summary assessment, okay, which is done by the centralized processing center. And it just corrects the arithmetical inaccuracy, the small adjustment errors, where there is incorrect claim or whether there is mismatch with the audit report, all of that. They do it. Now, what happens is the income tax officers or the income tax department also gets information from the third person. How? There are two ways to it. One is, well, let's say I have deducted the TDS as a payer. I will file the statement of TDS, the TDS return. There, I will give you a PAN number, right? Now, in case I have deducted your TDS, I have reported your income under your PAN. And if you have not reported the income in your return of income, obviously the income tax department will have the information that there was an income with you, which you have not declared. Number one. Number two, certain institutions are required to furnish the statement of financial transaction. Now, what is this statement of financial transaction? Statement of financial transaction, which is known as SFT. So, section 285 BA of the Income Tax Act requires furnishing the statement of financial transaction. 285 BA. So this is to be furnished by the registrar of properties, by the motor vehicles registering authority, by the recognized stock exchange, by the brokers, by the depositories, by the financial institution. This statement is required to be furnished for any transaction of purchase, sale, or exchange of goods, for any service rendered, for any works contract, for any investment. For all of these things, this statement is required to be furnished. Now, for this purpose, there are rules which are provided under Rule 114E. So, who is required to furnish the statement of financial transaction? This is to be furnished on Form 61A. Where let's say there is payment in cash for purchase of bank drafts, or where there is payment in cash over rupees 10 lakhs for purchase of any instruments from RBI, or there is cash deposit or cash withdrawal more than rupees 50 lakh from the current account, then the bank is required to report the transaction in this Form 61A. Or let's say if there is cash deposit more than 10 lakh through the saving bank account, then the bank is required to report that transaction. Or let's say where the FDs are taken more than 10 lakh, then the bank, post offices are required to report this transaction. Let's say where the credit card payment is made by 10 lakh of rupees 10 lakh or more. Or let's say if there is a payment made by any person of more than rupees 1 lakh in cash to the bank, then the bank is required to report that. Or let's say if bonds are acquired over more than rupees 10 lakh, then the company which is issuing the bonds will have to report that transaction. If let's say the company is receiving more than 10 lakhs for the share application money or for the share purchase, then the company issuing the shares will have to report that. If there is, let's say, buyback of shares over rupees 10 lakh, then the listed company has to report that. If let's say mutual fund units are acquired over rupees 10 lakh, then the mutual fund company has to report it. If let's say there is foreign exchange purchase over more than 10 lakh, then the authorized dealer has to report it. If there is purchase of immovable property more than 30 lakh, then the registrar will report it. If there is cash payment exceeding 2 lakh rupees for any sale of goods or services, then the person who is required to get the books audited will have to report it. Are we clear? So through this kind of reporting, the income tax department will get the information that you have done the substantial amount of transaction. Now, if you have done the substantial amount of transaction and if you have not filed your return of income, then ideally they would want to know what were the sources of your funds. If you have no income and if you have not furnished a return, then what were the sources through which you were able to undertake these financial transactions? So obviously, they may issue you the notice. But before this, now they have introduced a new scheme. Before issuing the notice, they will conduct now the faceless inquiry. They will conduct the faceless inquiry. Now, what is this scheme? So, this is called the e-verification scheme. So, e-verification scheme. So, let's say you are furnishing your return of income by, let's say, 31st July, right? Your return will be processed, let's say under 143(1), right? Let's say by 9 months from the end of the financial year. Let's say by 31st December 25. If you're furnishing your return of income in, let's say, 23. sorry, this will be 24. Right? Then they can come up with the e-verification scheme. So what is this e-verification scheme? Let's try and understand. In this scheme, the income tax department, if it has any information regarding the particular taxpayer, through their statement of financial transaction or through whatever data they have, then they can go for the e-verification option. Now, this is not the verification of your return. Verification of your return is different, where you e-verify your return through your Aadhaar OTP, through your digital signature certificate. That is different. This is the e-verification by the department. So, income tax department will gather the financial transactions about your receipts, where the TDS PCS has been deducted, where there is immobile property purchase, bank deposits, cash deposits, investment in shares, FDs. These appear in the annual information statement, AIS. You can see this information in your AIS also very well now. Now, if you find any transaction which is not pertaining to you, you can obviously report in the AIS by raising the objection. So, when a financial transaction is reported by any reporting entity and that is not considered by the assessee while filing the return of income, a computerized process of identification of the mismatch is undertaken. And the communication is sent first to the reporting entity by confirming that whether the transaction reported is correct or not. The one entity who is reporting the transaction, the one who may have deducted the TDS or the one who may have reported in the SFT, they can first either confirm or they can say that, okay, we have wrongly reported this transaction. So then that closes that particular point of time. But if they confirm the transaction, then the e-verification scheme will be initiated. Now, a notice under 133(6) will be issued to the taxpayer electronically. Notice under section 133(6). So if you see, I just told you here that power to call for information is there with the income tax authority under section 133. Income tax authorities have the power to call for the information under 133. Now, what does 133 provide that? It gives the power to the income tax authority to call for any information which it feels relevant. So the assessing officer or even the joint commissioner or commissioner appeals may call for the information. Let's say, for example, from the partnership firm, the name and address of the partners, what are their shares, what are the names and addresses of the manager and karta of the HUF. Then they may call for the information from the assessee for which they may think that this could be relevant, let's say in this particular case, for the purpose of reconciling the mismatch. Here they would call for information to reconcile the mismatch between the data reported by the entities and the income that you have not reported in your accounts or in your return of income. So 133(6) will be issued seeking the explanation as to why you have not reported the transaction in the return of income. So the explanation or evidence is required to be given by the taxpayer. And based on the explanation or evidence provided, the income tax authority will take a view as to what needs to be done. And what view it will take? Either it is satisfied with the explanation of the assessee, then the proceedings end there. And if the explanation is not found satisfactory, then the taxpayer can consider filing if explanation of taxpayer is not sufficient, file updated return under section 139(8). So the taxpayer will still have the time to file the updated return. In case he feels that he has missed out on reporting the income. And if the taxpayer is not doing that, then in that case, the income tax authority can consider this information for the purpose of making the assessment or the reassessment, which could lead to then tax demand and penalties. So in case the assessee does not go for the updated return, then any which ways they can go for the assessment or the reassessment. And that's where now we would start with. So the assessment or reassessment, first we will start with the assessment under section 143(2). Now this was the summary assessment. This is the normal processing of the return by the income tax, by the centralized processing center. Where what do? Is they just verify the basic information, the correctness, the accuracy of the return of income. Right? That is not the assessment. It is just the summary assessment as the name suggests. So here only the arithmetical accuracy, incorrect claim, if any apparent from the information, then disallowance of loss, after time period, then disallowance of expenditure or income, indicated in audit report, in tax audit report, disallowance of deduction after due date. This is just the summary assessment. Main assessments start over here. And what does section 143(2) provides? If the assessing officer considers it that the assessee has understated the income, AO considers that assessee has understated the income, or has computed excessive loss. Excessive loss, or has underpaid the tax. Then he can issue the notice under 143(2). The time limit for this is 3 months from the end of the financial year in which return is furnished. So let's say in this case, if the return was furnished in 23-24, then end of the financial year would be 3 months from that will be June 24. And then the assessee may produce the evidence as the income tax authority may require on the specified points. Are we clear? So this is the beginning of the scrutiny assessments. 143(2). Now again, under 143(2), if the AO wants to call for the information, if the AO wants to call for the information from the assessee, then he will issue the notice under section 142. He will issue the notice under section 142. 142(1). So, once 143(2) is issued, which is the beginning of the assessment, then in order to call for information, notice under section 142(1) is issued. Now, once notice under section 142(1) is issued, there will be certain points which will be given that this is what you have to give. So, for the purpose of making the assessment, the AO may serve on the person, requiring him to present the particulars or to produce the documents or to produce the balance sheets, P&L account, the statements, the bank statements, the passbooks, all of that in the prescribed manner for the purpose of the AO to verify that information. Are we clear? Now, from here, again, we will go back to the powers of the income tax authorities. As I said, the first power of the income tax authority, that the income tax authorities have the powers vested in a civil court they have the powers that the civil court have. And what are the powers of the civil court? They have the powers with the discovery and inspection, enforcing the attendance of any person, compelling the production of books of accounts, issuing commissions. So they have the powers which the civil court has. So what are the powers? Discovery and inspection. Then enforcing the attendance. And examining on oath. Compelling the production of books of accounts and documents and issuing commissions. So income tax authorities have the powers which are vested in the civil code. So income tax authorities have the powers to make the inquiry or investigation in respect of certain person. They have also the power to impound or retain the books of accounts. They have the power to retain the books of accounts for the period not exceeding 15 days. But after recording the reasons for impounding the books of accounts. If the period exceeds 15 days, then they may obtain the commissioner's approval. So they also have the power to impound the books of accounts. Power to impound books of accounts for 15 days. If greater than 15 days, with approval. Are we clear? Then they have also the power, as I said, to call for any information. They also have the power to call for any information. Whatever the information they feel will be relevant, they can call for the information from different person, which may be useful for the proceedings under the Act. They can also call for the information from the creditors or from the debtors in order to verify my claims, right? It's not just that they can only call for the information from the assessee. They can collect any information from other taxpayers as well. And to collect that information, they can enter any building or place within their jurisdiction on which they have the jurisdiction for collecting the information. Are we clear? So they can go and ask for the information also from the person who is carrying on the business or profession within their jurisdiction. And they have to furnish that information to the income tax authority. And if they fail to do so, it will attract the penalty of 1,000. In order to verify the information, they may also conduct the inquiry on the other taxpayers. So they can issue the notice, let's say to my creditors or debtors, to furnish the information or documents. And they will then use this information for the purpose of conducting the assessment on you. Now it has become the faceless collection of information. So calling for information, collecting the information, all these things are done in a faceless manner now, because a faceless scheme has been brought. Are we clear? Further, in case, let's say, for example, the income tax officer, if he feels that he would want to estimate the value of any asset, property, or investment, he may also make a reference to the valuation officer. So he can make a reference to the valuation officer. Here you can also write call for information under section 133, 133A or 133C. Then reference to valuation officer under section 142(2)A. If the income tax officer is of the view that the property asset needs the valuation, he can make a reference to the valuation officer. then the valuation officer will estimate the value of the asset, property, or investment after taking into account the evidence produced by the assessee and any other evidence which is gathered. And he would submit the valuation report within a period of 6 months from the end of the month in which reference is made. So within 6 months from reference. And then the assessing officer will complete the assessment by taking into account the valuation report. Again now, the scheme for issuing the notice under 142(1) or for that purpose making the inquiry or for the purpose of valuation, it is the faceless scheme again. Everything has moved into a faceless manner. It can also request for the audit of the accounts. It can also request for the special audit. The income tax officer can also request for the special audit and if it wants to get the special audit done, what are the conditions for that? Sorry, this is 142A. So if the income tax officer is of the opinion that the accounts or the nature of the account or it is complex, having regard to the nature and complexity of accounts, volume of accounts. If the accounts are voluminous, there is huge data, there are doubts on the correctness, there is multiplicity of the transactions, specialized nature of the business, the income tax officer may give the direction to get the accounts audited. So if he is of the opinion that the accounts are very complex or it's voluminous or it's a specialized business, then with the approval of the higher authorities, he may direct the assessee to get the accounts audited by an accountant and to furnish a report of the audit. Now, the special audit will be conducted by the accountant nominated by the Principal Chief Commissioner or Chief Commissioner or PCID or CID. And the auditor is then required to furnish the report in the prescribed form and in the prescribed manner, which is in Form 6B. The opportunity of being heard will be given to the assessor. So before the directions are passed to get the account audited, so the assessee will be given the opportunity before issuing the directions for the special audit. And the time limit is within 180 days. Within 180 days, the report of the auditor conducting the audit must be furnished to the AO. The AO can extend the time period for another 180 days, but it shall not exceed the 180 days total period. Okay. So assessee will be given the opportunity of being heard. Now, if the assessee fails to get the accounts done, the audit of the accounts done, the assessing officer can then make the best judgment assessment and impose the penalty. Failure to get audited, best judgment assessment plus penalty. Okay. But let's say, for example, if the CA only refused to get the accounts done, like CA refuses to audit the accounts. So in that case, whether the failure is on the part of the assessee to comply with the directions of 142(2)(a, the Supreme Court in that case said no. If the CA declined to undertake the audit of the assessee's account, the assessee cannot be held responsible. There was no fault on part of the assessee that he has not complied with the directions of 142(2)(a. So the best judgment assessment in that case cannot be made. Are we clear? So once you have the scrutiny assessment start, then in that case, the assessing officer has these particular powers. Now, tell me one thing. What is the time limit for the assessment, for completing this scrutiny assessment? So the time limit for completing the scrutiny assessment is given under 153. Is given under 153. And what is the time limit for this? What is the time limit for scrutiny assessments? Yes. What is the time limit? So the time limit is 9 months from the time limit under section 153(1) is 9 months from the end of the assessment year. From end of the relevant assessment year. So let's say my assessment year is 23-24, then 9 months from 22-23, 23-24 is the assessment year. So 9 months from 23-24 is December 24. I will have to get the my assessment will get over by that. I will have to pass the order at the income tax authority. This is provided under 153(1). In case it is a TP assessment, then additional 12 months are granted. In case it was the updated return, the assessment was for updated returns, then 9 months from the end of the financial year in which return is furnished. And as I said, if it is a TP assessment, then it will be how many months? 9 plus 9 months will be given. Then another 12 months, sorry, 9 plus 12 months. If it's a TP case, then 21 months. Are we clear? Any questions so far? Any question? From this time limit, of course, the direction, the time which is taken for the valuation to be done or to get the special audit done, that time period will be excluded. That time period will get excluded from this particular time limit. Clear? Any question? Jacob, there is reason for this so that there are enough check and balances. Like we have so many authorities even under the the regular any industry, if you see, or any company, if you see, there are so many, like there's executive, senior executive, then directors, partners, managers, senior managers. So many authorities are there. Why they are there? So that you could delegate the work properly, you can get the work done properly, there is enough check and balances, there is distribution of the work. So that's how even it is there in the income tax. Clear? Now, last one thing before we close the session. The entire assessment scheme has moved into a faceless scheme. The assessment is now carried out even in a faceless manner. Now again, the faceless scheme, what was there for the earlier attempt, has gone into a change in order to simplify it. So for your attempt, there is a new faceless scheme which is there. which we will be discussing day after. But just wanted to end on that note that this entire scheme which you are seeing now is going to be in a faceless manner. There would not be assessing officer interacting directly with the taxpayer. It will be the National Faceless Assessment Center, NFAC, which will be dealing with between the, or which will be acting as an intermediary between the assessing officer as well as the assessor. So that's what we are going to do it day after tomorrow. Fine. Any doubts, any questions before we end the session? Okay. So thank you so much. See you in the next class.